Well, this week the market recorded its biggest weekly loss in the last 7 months. The Nifty and the sensex closed with nearly 3% losses this week, and financials were the biggest drag. On the Editors Roundtable, we put the spotlight on HDFC Bank. We also talk about Indian bonds being included in JPMorgan's Emerging Market Index, which was the big headline of the week, and a deep dive into select stocks that have seen a big run largely due to limited float. Hello and welcome to Editors Roundtable. I'm Sonia Shenoy. With me are my colleagues Anuj, Nimesh and Nigel. Folks, you know, this was quite a, I mean, you can't call it debilitating, but it was a week when the bears took control of the market, right? We saw a fall after a while and a considerable amount of fall.
Yeah, I mean, the week where the bear said, I am alive, right? Because still last week it looked like, you know, the bulls were in complete control. And, you know, normally when we start to cheer too much is when the bear normally comes.
A reality check comes in.
Yes, and that's what happened, I think, this week. I think everyone was celebrating last week. You know, targets of 21,000, etc. were being given, and how things have turned. By the way, this was a truncated week. It doesn't feel like that by the Friday because of all the, you know, action that took place. But I think this week has, I'll call it trend reversal week, Sonia. It's changed the trend of the market, and the market for last 2-3 days closed at the lowest point of the day, which is an indication that some kind of trend reversal is happening.
I almost forgot about that midweek holiday. Actually, there was so much that happened this week, right?
You know, in terms of market action, you know, it reminded me of when you had Sachin, Sehwag as well as Ganguly. They used to be the top three batsmen. You know, and when they used to start off well, India used to do well. This week, you had Reliance, ICICI Bank and HDFC Bank. Between the three of them, close to 75% of the fall was accounted by three of them itself.
Yes.
So when the top guys don't do well, you know, sometimes you feel the pressure, but hopefully, you know, the mid level or the, you know, the lower, the tail can back hopefully. But otherwise, this week was a little bit concerning.
Even in this midst of 3% cut for the Nifty and Sensex, the broader markets have still outperformed. And this is despite selling pressure. In fact, on the last couple of days, the feedback I'm getting is at least the smarter HNIs are looking to book profits. We got some calls as well, right, from the likes of Lawrence Blanco saying that mid-cap index is looking like some bit of consolidation with a negative bias is expected. In fact, suggested some profit booking in some select mid-caps as well. So, despite all this and the fact that the smarter HNIs have started booking profit, the mid-cap index momentum continued and it was led by the PSU. So, on index, it may look like a 3% fall, a kind of consolidation. But the broader market party seems to be continuing, at least for the time being.
Yes, it did. But towards the end, even there, Nimesh, you know, I did notice the advanced decline was getting slightly worse off. But anyway, that for another day. First, Nimesh, why don't you tell us the feedback from the dealing rooms?
So, you know, as I said, you know, while the Nifty and Sensex looks like a 3% fall, it was not like there was carnage in the broader market. So that was one big takeaway for me. But the clear momentum was in the PSUs, and within PSUs, it was a PSU bank stocks. What a move in the PSU bank index, right? You spoke about the breakout in the PSU bank index last week. And in 1 week itself, the index is up, I think, 6%, right? And the individual names are up some 8-10%. So huge momentum in that space. So that continued. And there were flows as well. In fact, today the feedback was there was a PSU basket buying in the PSU bank stock. So that clearly shows that people are chasing the momentum. I guess the other big takeaway for me was while the markets consolidated, the momentum seems to be shifting towards the primary market now. Look at the kind of paper which is hitting the market. This week there were 4 IPOs, few more are lined up next week as well. So clearly the primary market action is picking up, and that's where a lot of you know, HNI interest and the larger investor interest is also there. Interestingly, I was just looking at the data of IPOs which hit the market in 2023. Surprisingly, not a single issue has given a negative return. So I guess that is also the reason why you know, there is momentum now chasing the IPO market. So that clearly stood out for me. And the last is, while you know, I've been telling about the fundraising plans, I've been also highlighting about the M&A activity picking up. We saw a big deal happening this week, Glenmark and you know, Nirma buying out Glenmark Life. My sense is there are more M&A deals lined up for next week and the week after, and the fundraising trend will continue. So that stood out for me, not only in terms of promoter selling stake, but even the M&A activity is picked up in the broader market.
The point on IPO is fascinating, and you know, the kind of pickup that we've seen in SME space, you know, it gives me a bit of a nervous feeling.
Different market altogether. Yes. I've been meeting a lot of investors and all. Every second day there is a you know, investor meet for the IPO markets, and the whole market has been buzzing. Like, you know, there's so many activity going on. It's crazy. It's really crazy.
In fact, joining us now is Hiren Ved, CEO, Director and CIO at Alchemy Capital Management. Hiren, thanks a lot for joining in. How are you feeling about the market now? There is a bit of a consolidation that we're seeing. You can't call it a correction, really. I mean, it's just sort of, you know, pausing for the moment. Are you getting a bit cautious at these levels, or would you buy the dip?
So, hi, Sonia. I mean, I think we are broadly we are all fully invested. So whether it's a pause or a correction, it's really not going to matter too much. But I think we've had a real hard run from April, right? So you've had a back-to-back, month-to-month, month after month, very strong moves in the broader markets, and it's quite possible that at some point in time you can't have speed and direction all in the same breath. So I think we've had a little bit of a consolidation move, which could even potentially turn into a correction, and which is absolutely fine. I think one of the things that we need to keep in mind is that while there's a lot of good news out there and the momentum has been strong, oil prices have moved up pretty substantially to $95 now. Obviously, they've corrected from the absolute high, but we need to just keep that in mind that oil above $100 is not good news for us, at least in the short to medium term. It may not really matter in the long run, but in the short to medium term, it could be one reason which could apply the brakes on this momentum in the market.
Okay, all right. Hi, Iren. Good to hear your thoughts. I wanted your view on HDFC Bank. That one was in spotlight this week after it saw a sharp cut post-brokerage downgrade. The stock is now either at a make or a break level. Well, Anuj, you've been looking at this closely. Run us through some data points, because this is going to be a driver for the markets from here on as well.
Well, absolutely. HDFC Bank is like what Virat Kohli is for the Indian team, right? The biggest stock in the market. And more than just the sheer weight of HDFC Bank, when HDFC Bank does well, you feel good about the market. And when it doesn't, you don't feel good about the market. I mean, that was the key differentiator this week, frankly, HDFC Bank. What changed this week for the market? It was this collapse in HDFC Bank. Now, I'm saying it a make or break level, but because just look at this chart. I think this for me is really the chart that's going to define what happens to HDFC Bank. This is a trend line that we have drawn from the post-COVID low up until now. And whenever it's taken support here twice. Once, of course, was immediately after COVID, and once it was in 2022. Both times, just look at the kind of move that you've seen. Yeah, this is the kind of move, and this is the move. And what has happened now is that you've broken this level. You've broken this trend line. Now it's just been broken on a two-day basis. Let's see if this sustains or not. But this, for me, is really a make or break chart. Now, what are the key points to consider from here on? What were some of the big worries? Now, I'm not going through all of them because we have limited time. One of the big worries was HDFC NPAs of 6.7%, which is higher than what it reported at the end of FY23 at 2.9%. And the concern was, why did this come? Now, I did try to speak to the management and others as well. And the sense I got was that this is because earlier they were an NBFC and they were adhering the NHB norms. And according to their own prudent calculation, that was the NPA. But now you have to adhere to the RBI rules. 90 days means an NPA, and that's why this NPA has gone up. The other thing is what's happening on the margins. Obviously, there's going to be a bit of a margin hit, and that's something that the bank has been quite open about. But will it be countered by volumes going up? There are two reasons for that. And again, I'm not saying it will happen. That's a big question. 30% of HDFC customers banked with HDFC Bank. That number can go up. And only 2% of bank's customers source their home loan from erstwhile HDFC. So, can this margin hit be compensated by cross-selling? That I think is going to be one big factor. The other big factor, which I think too many have looked at, there was HDFC's holding of 21% in HDFC Bank, which was extinguished. Obviously, that also means that in the consolidated profit, that number is not there. But in that case, there's a holding company discount as well. The net impact of this would be EPS accretive. That's something which, of course, when it goes in its favor, will be helpful. The next couple of quarters, though, are going to be extremely soft. Make no mistake about that. And that's what the market is telling, that, we have limited capital. Why to waste it on a stock where for the next two more quarters there's not going to be earning comfort? Why don't we go to some other stocks? By the way, one more thing. Just look at HDFC Bank's earnings profile. And this is the first time in last 10 years I'm using value stock for HDFC Bank. Never done that, right? Its price to book has averaged between 4 to 5 over the last decade. FY 2021 is when it started to come down. This was also the time when Aditya Puri was leaving the bank, right? The executive position, and was retiring. And look at where it's come down to now, 2.86 price to book. When was the last time you have seen HDFC Bank trade below 3 times price to book? Even if you look at the price to earnings ratio of HDFC Bank, it used to command 27, 28 times. It's now down to 17 points. 17 time price to earnings. That's what happens, right? And one last thing, I'll leave it with a popular meme in the stock market. This is the meme which comes back every time there's some kind of a shift in the market. Retail investors are right now just after public sector banks. HDFC and Kotak Bank are worried right now, but their time will come. I'm telling you the time will come. It's just that right now everyone is just obsessed with PSU banks. Yeah, this is
just explain that meme to me once again. Who is that girl? Who is the girl in red and who is the girl in blue, Anuj?
That boy is Nigel. I don't know about the girl. You ask Nigel.
Nigel, which one is the wife and which one is
I would
the
have
other
a good weekend. Don't get me into trouble.
But Hiren, that summed it up really well, right? That the stable stock is more like the wife, and then, the girlfriend is all of those fancy stocks like PSU banks that almost never give you good returns. Your thoughts on how to approach this one?
Well, I think, Anuj's table was quite instructive in itself, right? So if you saw, I'm not going to comment on the meme. I'll leave that to you guys. But I think the table was quite instructive, right? I think what's happened is that, obviously this is a very complex and large merger. I don't think investors, had thought that some of these adjustments to the book, the higher NPL, is something that, and by the way, this is the most researched bank in the world, right? So it tells you that how much people missed out on what eventually the combined entity would mean, both from an accounting perspective and maybe some of the variables that they spoke to the market, having a higher loss number. So I think it's going to take a little bit of time for the investors to get used to it. The second thing is that the derating has happened partly, obviously, because there was an Aditya Puri premium, which is not there anymore. Yeah. And the growth has also slowed down, right? So I think this was a bank which used to year after year grow at 25% PAT. Then it went down to consistently 20% PAT. Now, if you look at all the consensus numbers, we are talking about a 14, 15, maybe 16% kind of compounding. And therefore, the PE multiples or the price to book multiples have also adjusted to the fact that earnings will now compound. Yes, it's still a very solid bank, but it's not going to compound at 20%. It's going to compound at 14, 15%. That's also what the Nifty is going to compound at, right? So if it's so I think what investors may be thinking is that, is this a bank which will compound at faster than the Nifty earnings and will outperform the benchmark, or are there better alternatives that we can look for? And I think that's the question. So I think it'll take a couple of quarters for investors to get confidence back to see where the numbers settle, right? I mean, obviously there are great synergies, but investors need to see that in the numbers. And I think until they see that in the numbers, and it's going to take a couple of quarters for these things to settle down, my sense is that, that's what the market is reflecting, or the stock price is reflecting, that in the near term, we are not going to see a big outperformance from the bank, but eventually it will come back if it can prove that it can grow faster.
All right, one point on HDFC Bank, year to date, it's down close to 6-7%. In the last 10 years, it's never given negative returns. The last time it gave negative returns was in 2013. So hopefully it avoids that feat, from a market perspective. But Sonia, the big news we got late on Friday was with regard to India getting included in the emerging market bond. Big news, right?
That was big news, really. And, all the experts told us that will mean inflows into the Indian bond markets in a big way. So in case you missed out on that headline, right, JPMorgan included India in the JPMorgan Global Emerging Markets Bond Indices. Now, there's a maximum weightage of 10% that India can have in this global diversified index. And JPMorgan also said that 23 Indian government bonds with a combined notional value of $300 billion are eligible. Now, this, of course, has led to a rally in the bond market. A large inflow is expected into banks and domestic cyclicals as well. Just want to put out some views on the table. B. Prasanna of ICICI Bank, who we spoke to, said that from a long-term perspective, there could initially be $20 to $30 billion of passive inflows into the Indian bond markets. The rupee could appreciate further as well. And if India gets included in all three bond indices, then there could be passive inflows of $40 to $50 billion. IDFC First Bank said that in case India is included in the Bloomberg Global Aggregate Index, it could result in inflows of $15 to $20 billion, and they expect India's weightage to go up by an additional 0.6 to 0.8%. So, this, of course, was the big positive. But, Hiren, I wanted your views on it. From a bond market standpoint, of course, we do understand that passive inflows will come through. But from an equity market standpoint, what is your view?
So I think, Sonia, it's a really positive outcome. We've been waiting for it for a very long period of time. And I think if one of the indexes is included, I think it's only a matter of time when the other indexes will also include us, right? And I think $40-50 billion of inflows coming in will stabilize the rupee. Now, there are two positive impacts of that, right? One is that for foreign investors who invest in the equity markets in India, not only do they have to take a call about what returns they can make, but they also have to factor in the currency impact. And usually, if you take a slightly longer term period, the rupee has depreciated against the dollar by about 3.5% average annualized, right? Now, if you have another source of inflows, which is steady, which could be anywhere between $30 to $50 billion, depending on how many we get included in which indices, that's going to probably bring a lot more stability and confidence to the rupee. And that would mean that India would become even more attractive. Anyways, India was one of the fastest growing and most attractive equity destinations. But now with the currency also being in the favor of the foreign investors, you could see even more flows coming into the equity markets because, there could not, hopefully there won't be as much depreciation of the rupee that we've seen in the past. That's one. The second impact of that is that it helps as bond yields cool down. You could see cost of capital come down, right? And that's good because that's good for risk assets. India needs a lot of capital to build infrastructure for growth, for entrepreneurship, for risk taking. And I think falling cost of capital means a higher P multiple. So I think India's premium could well be more durable because if bond yields come down, the equity premium will reduce. And cost of capital will also come down, which helps equities and valuations.
All right, Hiren, thanks a lot. We just need to take a short commercial break. We'll keep coming back to you for more. A slew of stocks have seen a big run up, but this is largely due to a limited free float. So we'll get you a special analysis on the other side.